Good afternoon and welcome to the Vincent's webinar relating to the upcoming federal election. So with the calling of the election, given the fact that we've just had the budget, we're in a fairly unique position where we can actually talk about basically the economic policies, or certainly the tax and super policies of the three major parties. So today, Kim Reynolds and myself will be discussing the taxation and superannuation topics in relation to the upcoming election on the 18th of May. Now, I suppose this election is a little bit interesting insofar as technically the incumbent government, being the coalition, are actually a minority government. So they have 76 seats in the House of Reps, whereas really you need 78 to control the lower house. The Senate is a little bit different because half of the senators actually, their term ends at 30 June this year. So we will be voting for a half Senate at this election. So if you have a look at the slide there, you'll notice that we've got some numbers. So those numbers that are shown there, they're the existing numbers for the three major parties and obviously the independents as well. Now, the numbers in brackets for the Senate, they're the seats that they will continue to hold from 1 July onwards. So using the Greens as an example, they actually have 6 of their senators up for re-election this term, and 3 will continue post that. So it'll be quite interesting to see how that dynamic works in relation to the Senate in particular, because ultimately it's all well and good for the government, whoever controls the lower house, to have particular policies, but unless they can get their legislation through the Senate, then essentially it doesn't really achieve too much. And we've certainly seen that a lot over the past few years, where policies have been, or bills have been introduced into the upper house, but have gone nowhere. I can't remember the exact number, but there's an extraordinary number of tax and super legislation that basically was prologued.
Yeah, there were about 177 bills, I think, that were around at the time in that week leading up to the announcement for the election. There was a little bit of a flurry in that last week of getting some bills through, but not a lot. So yes, there's a significant number that we still now need to go through the whole process again.
Yeah, and some of those have been basically stuck in the Senate for 3 years.
So there's a couple even longer. Yeah, that's right.
Because basically, when an election is called, all those bills are essentially removed, and then the new government, whichever side they are, then have to reintroduce them back into the lower house and then back into the Senate.
Exactly right. Yes.
So they'll be, if the coalition is re-elected, then they'll be busy just trying to get their previous legislation through Parliament, let alone anything else they want to do.
Exactly. Yes. And I think in the past we've seen where if we knew who was going to win the election, we could have a fairly good idea, I guess, as to what we were going to be dealing with post-election, depending on which party was to win the lower house. I think in recent times we've seen a bit of a change in the way the political landscape operates, and now it's almost regardless of who wins on the 18th of May, it will very much depend on how the Senate's made up as to what really happens as far as the government's concerned, and what our tax laws and super laws, to keep it on point for today, is what they're really going to look like, because there's some differing views across each of the parties, and the Senate, with its where the Greens tend to have a bit of sway, and also the increase of independence over recent years, there is what the major parties want may not necessarily be the case.
Yeah, I think the independents in the Senate will be the real thing to watch for the election nerds like us, Kim, in the Senate, because ultimately, currently there's 11 in the Senate. Now, that number, depending if you believe the polls or not, may or may not actually increase. So if it does increase, typically Independents sit more on the right-hand side, so more on the conservative side. So that'll be really interesting to see how that all plays out really
yes.
well.
Yeah, that's right. So without further ado, we just thought we'd spend today having a look at the tax and superannuation announcements so far. And no doubt that some of these may change over the coming weeks as the parties test the water to see what sort of reception they're getting in relation to some of their announcements. So we've concentrated today mainly on, as we said, the three main parties, so the Greens, the Labor Party, and also the Coalition. So firstly, starting with the Greens and their tax announcements, given that they're a party of a particular ilk, their tax announcements are not necessarily as thorough, I guess, as the two major parties. Having said that, they do have some areas where they do want to see some changes, and that's where my comment before about the makeup of the Senate will be important, because they will have some particular sway depending on whether it's Labor or the Coalition that are ruling the lower house. So as far as the individuals are concerned, the Greens are looking to essentially reverse the tax cuts that they see that have been provided to wealthy Australians. As far as the details are concerned, we don't have a lot of details. It's really just we want to reverse those tax cuts that have been announced or provided for by the other parties. There's also a proposal to cap deductions for wealthy individuals. So essentially what they refer to that as the Buffett rule, where individuals essentially have to pay a baseline amount of tax no matter what deductions they have. So they're looking at capping deductions so that where somebody earns income of more than $300,000, then they won't be able to deduct amounts to a level below them having to pay 35 cents in the dollar of tax. The other item that's going to impact on individuals as far as the Greens are concerned is that they would like to remove the public subsidies for private health insurance. So as we know, there are private health insurance rebates that are provided to individuals and families to help deal with the cost of private health. And what essentially they want to do is remove those rebates and allow, or essentially redirect those funds to the health system itself. It sounds very noble at a high level, but the practicalities may be a little bit more challenging. So as far as businesses are concerned, the Greens are looking to also reverse announced and legislated tax cuts. So currently there are company tax cuts in play, and also probably further announced for businesses that have got a turnover of more than $10 million. And the Greens would like to reverse those. So it's only small businesses with a turnover of less than $10 million that are treated as small business entities and have a lower tax rate. So essentially restoring the tax rate to 30% across the most organisations, most businesses. The mining and resources sector, they're looking at essentially bringing back the proposal that was made in the Henry Review back in 2009, where in that review, Henry proposed a 40% super profits tax for large oil and gas and mining companies. So that's something that's on their agenda. Didn't really get a lot of positive feedback when it was previously tried after the Henry Review, so I'm not quite sure how successful they'll be here. And the mining sector has gone through its ups and downs since that time, so it's a different landscape that we're dealing with as far as that's concerned. Also increasing in the ATO resources, and this is something that I think is consistent across all of the parties, looking to essentially increase ATO resources to allow them to better manage and the revenue and collection of revenue, I should say, and also making sure that they can be more on top of any tax avoidance strategies that might be in play, and dealing with those more in real time. So that's something that we can see across the different parties, and they're all approaching it in slightly different ways, but there is a common thread there to essentially crack down on tax avoiders and making taxpayers more accountable for the tax that they're required to pay under the law. There's also a proposal for a settlements register. Again, this is something that's consistent with, I think it's Labor's policy, where looking for the ATO to release details of settlement arrangements that they've reached with taxpayers so that it's more transparent, making sure that the public can be aware of what sort of settlements are being arrived at by the ATO, and putting a little bit of a spotlight back on the tax officers to the basis on which some of these settlements are reached. In relation to trusts, this is a little bit of a strange one, and one of the beauties of election announcements is that there's not always a lot of detail, and the Greens have said that they want to crack down on the tricks of tax avoidance, like trusts and superannuation funds.
So they've heard something, but they don't really know what it is.
Yes, yeah. So trusts are the big baddies, and they're looking to deal with whatever tricks are used in relation to dealing with these trusts. So there's not any real detail there, but it's an indication that the Greens may support Labor in their, one of their proposals in relation to dealing with trusts, which I'll go through shortly. Also reintroducing a carbon price, which essentially goes back to the Greens and where they've come from, is looking at the environment side of things. So they want to introduce essentially an economy-wide carbon price on direct emissions from certain types of facilities. So I won't bore you with the details of what they have announced in the specifics, but yes, it's an economy-wide carbon price that they want to reintroduce. And the last point that I had there on the slide was in relation to electric cars. And that might seem that it's not a tax issue as such, but the electric cars did seem to get a little bit of press in the last week, with everybody being forced to drive electric cars in the near future. But the Greens have a target that there will be 100% of new passenger vehicles will be electric by 2030. The relationship with tax in that announcement is that they want to remove the import tariffs and other taxes relating to electric cars to make them more affordable to the average punter. So that's part of their policy. It's, I think we're seeing that it is the way of the future. It's whether 2030 is the date or something else, and whether those import tariffs and other taxes are reduced or eliminated. Governments are very reliant on their tax income, so I'm not quite sure how successful they will be in arguing for that position.
Oh, but 2030 does seem to be this ideal date for electric cars, because that's what Labor's talking about as well. So.
That's right, yes. Yeah, and it's more than 10 years. It's 10 years away, so it's future us problem. Yeah.
So in relation to superannuation with the Greens, they haven't actually released any of their policies. So the easy thing to, I suppose, the only really thing to note there is that they do want to do something around their tricks, but that they believe happen inside super, but they don't have any other specific policies relating to super.
Okay, well, that was pretty easy for you, wasn't it?
Very, yep, that was easy. A hard one.
Yeah. Okay, so as far as the Labor Party is concerned, now given that the Labor Party's been in opposition for a while now, they've had quite an opportunity to put together what their policies are and sort of build on those over the last few years. And I guess the one that we've heard quite a lot about in recent times is the removal of franking credit refunds. Now, you'll have no doubt heard about this announcement. It's been in the press for quite a while now, particularly in the context of superannuation funds and self-funded retirees, and Brett will talk about that a little bit more later. But they have stuck by the policy, even though there's been significant commentary and as to its perceived unfairness to particular segments of the community. So it doesn't look like something that they're going to back down on. Whether they're forced to when push comes to shove and we get to that point where the legislation has to go through Parliament, we'll have to wait and see what it's all made up of. But they are sticking to their guns. So essentially what this proposal means is that there's a winding back of the concession that was introduced by John Howard and returning essentially to the original imputation arrangement, where imputation credits are used to reduce tax but not to provide cash refunds to the taxpayer. So as I mentioned before, it particularly impacts on superannuation funds where they're taxed at 15% or at nothing. So there is, in majority of circumstances, going to be some refund around for super funds.
Yeah. So in relation to super specifically, ultimately it's really going to depend on the type of fund that the superannuant is actually in. So there are some large APRA funds, APRA regulated funds, so the public offer or industry funds, that are specifically designed to be pension funds. So any member of those funds will be impacted. Mm-hmm. Members of self-managed funds will also be impacted. But potentially the members of industry or retail funds that have participating members insofar as contributions being or concessional contributions being made, they're less likely to be impacted by that. So that's where this measure, I think, in my mind, I think that's where it becomes a little bit unequitable, insofar as it depends on the type of fund you're in as opposed to structures or anything like that. But there's a lot of water to run under the bridge, assuming Labor does actually get elected, particularly around the Senate. And it could very well be that there'll be horse trading that occurs where a threshold is put in place where a certain amount of franking credits would be allowed as a refund. Mm-hmm. Who knows? But to me, the real challenge around this measure is actually going to be the cross-matching between the super fund and the individuals, because some of the carve-outs they've already spoken about with this policy is if someone was already in receiving a government pension before a particular date, then they would be excluded from the measure. In other words, they would receive the franking credits. Now, it's at a high level, it's very hard for the super fund to actually know which of their members are in or out, and so particularly for those large APRA funds, it's going to be really hard.
Yeah.
So it's almost going to be the ATO are going to have to do a lot of the validation, so to speak, or the determination of what refunds would actually apply. So that's going to be, I don't know how that'll work practically for those large funds.
Yeah. Okay. Well, that's something to, I guess, wait and see. And it might sound like a good idea at the time, but the practicalities of getting it to work will take a little bit of planning.
Yeah.
Yeah. So the other item that the Labor Party has announced in relation to individuals is an increase in the individual marginal tax rate. So essentially increasing the top marginal rate back to 47%, so plus the Medicare levy of 2%, so essentially a top marginal rate of 49%. This really reintroduces the temporary deficit levy that we had a couple of years ago. And the reason for that is that Labor doesn't actually believe that the budget has been repaired yet, but have said that they will review it when the budget is back into a substantial surplus. So although the government did announce a surplus for 2020 in the budget the other week, the Labor Party has said, well, that's 1 year. Let's see how we keep going, and if we can sustain that, then we'll consider reducing tax rates. But until then, that won't be the case. Also, in relation to the CGT discount, this is something that has been around, they've spoken about for a little while as well, is that the Labor Party's view is that both negative gearing and the CGT discount haven't achieved their aim of boosting housing supply and encouraging people to build new houses. So their costings, particularly in relation to the CGT discount, indicate that the cost to the budget has more than doubled in respect of the discount, has more than doubled since 2014. So the cost of the budget of the CGT discount in 2014 was about $4.2 billion. And in 2019, it's expected to be about 8.6 billion. That's B, not M. So that's a significant increase. So with that in mind, the Labor Party is looking to halve the CGT discount for all assets that are purchased after a specific date. There have been particular dates bandied around, but I'll wait and see as to exactly what dates it will happen. This change to the CGT discount will be grandfathered, so it won't affect investments that have been made prior to a particular date. So tying in with that, we've also heard the Labor Party talk about negative gearing. And so their proposal is to limit negative gearing on new housing from a particular date. Again, it'll be grandfathered so that it won't impact on investments made before that date. And negative gearing losses will be able to be offset against income tax liabilities, investment income tax liabilities only. Losses in relation to those negatively geared assets would be able to be offset against the capital gain of that investment down the track when it is disposed of. So it's again, it's not a secret. They've been talking about it for quite a while now. Whether they are able to get that through the House, this is one where they've been particularly they've stuck their heels in. So we'll see how the Senate deals with that.
I think what's really interesting around this, Kim, is, as you said, both of the CGT discount and the negative gearing policies, they really announced best part of 2 years ago.
Exactly.
And since that time, and at that time, they were talking about it being a solution for first home buyers to get into the booming Sydney and Melbourne markets. Obviously, those housing prices have come back quite dramatically, about 20% or something, in the last 12 months probably. So it almost is a case that they've gone early on something that has now there may not necessarily be a community driver behind it. And that community drive, being that first home buyer leverage, I suppose.
Although I imagine if you spoke to somebody in Sydney or Melbourne, still they're first home. They're probably hoping that saying they still need some assistance. So this can still come into play from that perspective.
Definitely. But I think it's interesting though that you talk about how the Labor Party is saying that it hasn't actually helped new builds or anything like that. The Australian Mortgage Association has actually released some statistics recently that show that of the loans that their brokers have dealt with, which is I think about 70% of the market generally of all new loans, that it's something like 64% of those loans were for new builds.
Okay.
So there is actually some
evidence to the contrary.
Yeah, and some disparity around Labor's position.
Yeah.
And personally, I take a lot of the economic modelling, regardless of which political party and who does it, with a grain of salt, because they talk about how they believe the capital gains tax discount impact is what was it, $8 billion. Now, is that based on a lineal sliding trajectory based on the previous growth? So in other words, history determines future growth, or are they actually trying to pare that back given what we've seen in the last 12 months?
Yeah. Well, I think the 18 number was actually pretty close. So based on real numbers, it is definitely increasing. So so there is a cost to the bottom line, as you would expect, and it is increasing. So so there's a little bit to look out for there. So as far as the other things for individuals, the Labor Party would like the listed companies and trusts to disclose the beneficial ownership of their of those companies and trusts. So a publicly accessible register that shows who is actually owning our Australian, well, the companies and trusts that are listed on the exchange. It doesn't apply to unlisted entities, but it may only be a matter of time before we have to list who the beneficial owner is of a particular entity. At the moment, there is no requirement to list who the beneficial owner is for either listed or unlisted entities.
Geez, that'd get hard with super funds.
It would, yeah, exactly right. Also, one I found interesting was that there will be a requirement, or the Labor Party would like there to be a requirement for all Australians that have foreign citizenship to report that to the tax office, so that they can be clear as to, from the ATO's perspective, what other jurisdictions they need to liaise with to collate information in relation to a taxpayer. I did think that maybe it might be helpful for some of the politicians to know where they were citizens of as well. So
3 coalition members come to mind.
That's right, yes. So that could be useful for a number of things. I mentioned before about the Greens talking about the tricks of tax avoidance in trusts. The Labor Party are looking to introduce a 30% tax rate on trust distributions that are made to adults. So it's aimed at circumstances where tax can be paid at a lower rate if it's split amongst beneficiaries that have got lower tax brackets. If the rate of the tax rate of the beneficiary is less than 30%, then the rate that's going to be applied to the distribution will be the 30% rate. Doesn't apply to distributions to minors, but I think that's probably dealt with fairly well within the legislation anyway, and particularly if they also get through the legislation about removing franking credit refunds. But it's going back to the time when we had a proposal about entity taxation where trusts were going to be taxed like companies. So it's going back to that sort of high level thinking. The mechanics of entity taxation proved to be quite difficult, so much that it was just binned really and didn't proceed. So we'll see how this works out. It might be a withholding type arrangement from the trust that's required to be made. The last item in relation to individuals relates to a $3,000 cap on deductions for the management of tax affairs. So essentially this is individuals being limited in the tax deductions that they can claim for the expenses that they incur paying their advisors to prepare their tax returns or getting tax advice. So we capped at $3,000. It does only apply to individuals. It has had a little bit of press over the last week or so.
Well, the Chartered Accountants of Australia and New Zealand have actually asked Labor for an apology on this particular measure. So
yes, they've made a couple of submissions in relation to this particular measure. So it's a tricky one because there's a lot of taxpayers out there that to spend $3,000 on managing their tax affairs they think would be ridiculous because they could never see them paying that much. But there are others that have quite complex affairs, including for themselves individually. So they $3,000 doesn't seem to be a lot, but we'll see how that plays out along the way. So in relation to business, Labor has said that they want to deny a deduction for companies where they're providing travel to and from known tax havens. I don't know what happens if it's an unknown tax haven. So the companies are going to be denied this deduction where the travel is taken. Obviously, the thinking behind it is to prevent businesses setting up arrangements where there'll be tax leakage out of Australia. There's a proposal also for the Corporations Act to be amended so that it will require companies to disclose to shareholders if the company is doing business in a tax haven. It's not clear really from the announcement as to whether that's going to apply to the corporate group or just to a specific entity, but it's an interesting approach. But it goes within this general theme of making sure that big businesses pay their fair share of tax, as the government likes to call it, and the ATO and the Australian government, whoever that might be, has the power to go, or the ability to go and look for funds that might be offshore, that people are squirreling away. There's also going to be a requirement for government tenderers to disclose the country of their domicile. It does seem to be a very similar sort of information collection exercise as the US government, US tax authorities do for taxpayers that are in the US. On the positive side, they're looking at reducing the small business tax rate down to 25% by 2022. That's a 2021-22 financial year. And applying to, and small businesses basically being companies with turnovers of less than $50 million. We also talked about an investment guarantee, which is proposed to kickstart new investment and deals with accelerated depreciation and immediate expensing of particular acquisitions. So it'll apply from the 2021 financial year, applies essentially to all businesses, which will allow them to immediately expense 20% of the value of eligible depreciable assets. The balance of that asset will be depreciated using normal depreciation rules. It's proposed to apply for tangible and intangible depreciable assets that are valued at more than $20,000 or bought for more than $20,000. So whether that threshold changes as a result of the immediate deduction now being available for up to $30,000 for small business entities, I don't know, but essentially it's going to apply to the larger assets. It's not going to be applicable to buildings or structures or R&D expenditure. Also, interestingly, not going to be available for passenger vehicles, so we can't go out and buy our car through the business and claim the deduction that way. Debt deductions, I won't go through this in any real detail, but as far as debt deductions are concerned, the thin capitalisation rules can limit deductions where certain debt equity ratios aren't maintained. There are currently 3 tests available in relation to how you work that out, and they're looking at simplifying that into a single test, being the worldwide gearing ratio. Also, a public disclosure of the country-by-country reporting. So at the moment, that really relates to the larger end of town, so where there's a turnover of more than $1 billion globally. Interestingly, very small entities can get roped into that just by virtue of a very large organisation owning a 50% interest, say, in a small company. So it's essentially going to be requiring that information to be publicly disclosed, as opposed to at the moment that the tax office has access to the information, but not really anybody else. And penalties for promoting tax evasion and avoidance. Again, this is that common theme that's running through. These promoter penalties do currently exist, but the proposal is to increase the penalties for individuals and entities that are promoting tax evasion and avoidance, similar to the coalition essentially funding the ATO task force that was announced in the budget last week, or week before last. And introducing public reporting of AUSTRAC data, so that AUSTRAC provides an annual release of international cash flow transactions, so that we can see as the public where the funds are coming from into Australia and going to when they're leaving Australia. As far as people that are guilty of tax offences, then those that have been found guilty, they want to allow the tax office to name and shame those individuals and entities that have done something wrong. Initially, that focus is on phoenixing type arrangements, but the intention is to expand that to all sorts of serious tax offences, and also allow the ATO to apply to ASIC to have them formally disqualified directors that have been engaged in non-compliance or have overseen some form of non-compliance. There's a proposal also to provide free tax clinics to provide tax assistance to disadvantaged communities. This is a proposal that sets out putting 10 clinics around the country, staffed by volunteers, and those particular tax clinics may be able to register as tax agent in their own right. So individuals might be able to get their tax returns done in those via those tax clinics. It probably is just an example, really, of how complicated the system is, that the government thinks it needs to set up these free clinics to get somebody that has very simple tax affairs, that give them assistance to actually get their returns lodged. And the managed investment trust, there is a current withholding rate in relation to these distributions that are made from these trusts, where distributions are attributable to investments to build, the Labor Party refers to it as build to rent housing, where the distributions relate to that type of investment, and then the proposal is that the rate will reduce from 30% down to 15%. So that was everything from the Labor Party, and I guess that probably evidences the fact that it means that as far as they've been in opposition for a number of years now, they've had a fair bit of time to think about everything. So there's a bit more detail as far as the Labor Party is concerned than what we saw obviously in the Greens, and I guess what we're seeing announced as far as election announcements are concerned for the Liberal Party. So going on to the Liberal Party, the coalition, I should say. It's not just the Liberal Party. The coalition. There's a proposal to reduce the 32.5% marginal rate down to 30%. Now, some of these, I guess, as I go through them, some of these things are probably not new to those of you that might have listened to the federal budget webinar that we did a couple of weeks ago. A lot of the Liberal and National Party policies were really put forward in that budget. It was an election budget, quite nicely timed, I think, as far as the election was concerned. So there may not be anything really new here, but again, something just to be aware of. So the reduction in the marginal tax rate from 32.5% to 30%. This will be effective from 2024-25, so you do have to wait a little while till that comes into play. And this is in addition to the abolition of the 37% rate that's already been legislated. The view of the government is that this will mean that the majority of taxpayers, I think in their numbers, they've said that 94% of taxpayers will be affected by this. It'll mean that majority of taxpayers, 94%, will have to pay no more than 30% tax. The increase in the low and middle income tax offset, so doubling that tax offset to $1,080. This was announced in the budget and is effective for the 19 income year. So for those individuals that are impacted by that offset, when they lodge their 2019 tax return, they will get access to this particular offset, which is doubled from what was announced last time. Yeah. Also, increasing the top threshold of the 19% tax bracket. So from 2022-23, again, you have to wait a little while for this one. The 19% threshold will increase from $41,000 to $45,000, and the low income tax offset, which is different to the low and middle income tax offset, will increase in the same year from $645 to $700. There is a proposal also to increase the Medicare levy threshold, but so that happens every year, but it's so they'll increase the threshold a little bit more. ATO data sharing is going to happen in a little bit more real time. There's going to be an expanded collection and use of data collected through the single touch payroll. The idea behind this, according to the government, is that it'll reduce the compliance burden for employers and for individuals having to report information to multiple government agencies. And an example of that is where people that receive Centrelink benefits need to report to Centrelink on a regular basis where their income situation changes. With single touch payroll, the income that an individual earns will automatically be exchanged with Centrelink, and Centrelink will then automatically adjust the pension payments or whatever other social security payments need to be adjusted at that point in time. So it prevents under or overpayment of benefits each year, and particularly Centrelink having to chase people to repay amounts when they probably can't afford to pay it back. So there's an estimated $2 billion saving between now and 2022-23 using the single touch payroll to simplify and essentially automate the employment income reporting for the social security side of things. So that is a significant saving if that is what's obtained, really. Expanding the instant asset write-off. Now, we heard about this in the budget, and this is one of those pieces of legislation that I'm not quite sure I can remember that piece of legislation moving quite so quickly. I guess the advantage was that the government already had legislation sitting in Parliament that increased the threshold to $25,000. So it was a matter of making some changes to that to expand it to the way that it was announced in the budget. So an immediate deduction for purchases of eligible assets that cost less than $30,000, where the business has an aggregated turnover of less than $50 million. And it has been legislated now, Royal Centre's there, so it exists. For those of you that are trying to advise clients on this particular instant asset write-off at the moment, just be aware and very conscious of the fact that for 2019, that means we've got 3 thresholds that we're dealing with. We're dealing with a threshold of $20,000 up to the 28th of January. From the 29th of January until the 2nd of April, budget day, then it's a $25,000 threshold. But then from the 3rd of April to the 30th of June this year, it's going to be a $30,000 threshold. So, and remembering the asset needs to be installed, ready for use, etc. So just keep an eye on when things were bought and when they're actually installed, ready for use, etc. Strengthening the ABN system. Again, this is another announcement in the budget where, in an effort to disrupt the black economy, which seems to be an ongoing target, I think, and looking at ABN misuse, looking at aligning ABN holder obligations with, as the government said, community expectations and making them compliant with the tax laws. So from 2021-22, there's going to be a requirement to lodge a tax return in order to retain your ABN. And then from the following year, it'll be a requirement to confirm the ABN details on an annual basis. So as many of us will have seen, that there are taxpayers that are having ABNs cancelled because they're either not being used or haven't been registered appropriately, etc. This is an effort to try and tidy that system up, because I expect that there are quite a few ABNs out there that probably have no real basis for being in existence. And the tax avoidance task force, we heard in the budget that the budget provided that ATO with $1 billion to increase targeting of multinationals, large public and private groups, and high net wealth individuals that have got a net wealth of over $50 million. So it'll also enable the tax office to increase its scrutiny on specialist tax advisors and their intermediaries that might be promoting tax avoidance schemes or strategies. So it's something, again, to be aware of. And for those of us that have seen an increase in ATO review and audit activity in recent years, I don't think it's going to end anytime soon. So something to look forward to.
So talking about the superannuation announcements, if you like, or policy announcements that we have between the 3 major parties, as we've already discussed, the Greens basically really haven't announced any policies, and the coalition's policies are basically what they introduced in the budget. So those being a change to the work test, so increasing the age essentially that you need to comply with that from 64 or under 64 to being under 66. An increase in the age for a spouse contribution to be made from 69 up to 74, and extending the ability to use the bring forward for the non-concessional contributions in line with the changing of the work test from 64 up until 66. So we already know those, if you like. And I don't see there being any changes by the coalition around super. They've already helped way too much in the last 3 years. So I think they will pretty much leave it at that. Labor, on the other hand, they do have about 7 policies that they've got on the table at the moment around super that they've, I suppose, more recently announced. There is actually another one that does date back basically 3 years that the last time I checked was still on their website under their policies area, but they haven't been talking about it. So I think that with the coalition making I'll call it the dramatic changes they made at 30 June 2017, I think Labor probably won't push that agenda. So their notion when the coalition, prior to the coalition introducing a $1.6 million pension cap, Labor were talking about having a $75,000 pension income cap. So that's where a pensioner could earn tax-free up to $75,000. Anything more than that would be taxable. Now, that was still, I suppose, part of their public policy, but they haven't been talking about it. So I don't think they will pursue that, but obviously time will tell. As far as what we do definitely know that as far as Labor's agenda goes, they want to reduce the non-concessional cap. It's currently $100,000 down to $75,000. So the bring forward being 3 times that would also decrease by essentially $75,000. So essentially making it more difficult to get post-tax money into the concessionally taxed environment of superannuation. The Labor Party want to reduce down the threshold for what's called Div 293 tax. So that's where if your adjusted taxable income is greater than a certain amount, you pay up to 15% tax personally on that money going into super, on that contribution going into super. So currently that threshold is $250,000. Labor want to reduce that to $200,000. In the 2018 budget, the coalition announced 2 policies that Labor basically now want to reverse. They want to get rid of those. So one of those is being a notion of a catch-up of concessional contributions. So that's where from 1 July 2018, if you don't make maximum concessional contributions over the next, say, 5 years, you're able to actually go back and say, well, I've only put in $10,000 instead of $25,000, so therefore I have $15,000 concessional contribution I can make. And you can do that for the 5 years previously and use it in 1 year to claim a deduction for contributions going into super. However, you had to have less than $500,000 inside super. So the notion behind it was essentially to help parents returning to work after having parental leave, where they may all of a sudden have some cash flow to make more contributions into super because they've returned to work. The reality is that isn't going to happen, and it's really about selling an asset that you have that cash available to put money into super. So while I think like a lot of policies that are introduced by the political parties, their intended purpose and the practical consequences are quite different.
So the devil's always in the detail with those things. So,
yeah, exactly.
Getting it to work practically can be quite difficult.
Yes. Yeah. Anyone who has had children and they return to work and they're paying $20,000, $25,000, $30,000 for childcare, don't really have a lot of cash there to start contributing into super.
Exactly.
Labor also want to reintroduce the 10% test. So that's where if you are substantially employed, and by that it means that if you earn more than 10% of your taxable income from a wage and salary type arrangement, you're not able to actually make a personal contribution and claim a tax deduction. So the 2018 year is the first year that we can do that, where it doesn't matter of the source of funds, essentially.
Okay.
If you want to make a contribution, you can claim the deduction. Labor actually want to go back to the old rules, which practically, as an accountant, really don't work, and it's really awkward to deal with. But if that's the rules that we have to deal with, then it's nothing unusual because we've been there before. One of the interesting policies that Labor have introduced or have mentioned that once again relate to this housing affordability notion is the removal of limited recourse borrowing arrangements with inside self-managed super funds. Now, I can foresee some horse trading, if you like, with this measure, insofar as at this stage they've only said that they're going to get rid of all borrowings. I can see where it will likely go to residential borrowings, but they still will allow commercial arrangements to be put in place.
Right.
So where a small business owner might want to move their property inside of super for asset protection purposes. But once again, no detail around it. They've just said we want to get rid of these things.
Okay.
And two super guarantee measures. So the first one relates to having super guarantee payable on parental leave, and also for where your wages are under $450 per month. So currently, an employer is not obligated to pay super guarantee on either of those two things. Labor want to change that. And also, Labor have made reference that they want to increase the super guarantee from currently 9.5% up to 12% when economic conditions are right, whenever that means. So that's there. Once again, no time frames around it, no detail. Essentially, it's just what they would like to do. And that notion of 12%, that was actually legislation going back to about 7 years ago. However, it's been deferred essentially by the coalition governments for the past two election cycles, with no time frame at this stage about increasing it. But Labor have, I suppose, put it back on the agenda, saying that they do want to go there. So as far as superannuation goes, I suppose a fair bit of tinkering, if I can put it that way, but certainly not a lot of heavy detail or big issues that we need to be considering as far as the structure of superannuation itself. So now, as Kim and I have mentioned, we did do a webinar on the budget a couple of weeks ago. So there's some links there to that. So if you want to, I suppose, have a bit more of an in-depth review of the coalition's policies, then that's probably as good a place as any, because that's really where a lot of the coalition's policies have come from. And Labor's policies came from their reply speech.
Exactly right.
From the budget. So it's quite a unique election cycle that we're in.
It is, yes. Yeah, I don't think I've ever experienced one quite like it. So where everything's been laid out in some detail, but not quite the way that you would expect it to be. So
and I think some of that also has to do with the fact that the pre-polling, that the increase in pre-polling that seems to be evidenced over the past, I suppose, increasing over the last few elections. More people are voting earlier via absentee.
Need to get the policies out earlier.
Exactly. They can't do their big announcements in the weeks before. They really need to be on the front foot a lot earlier.
Yeah, that's right. Okay, well, I'd like to thank everybody for attending to the webinar today. If you've got any questions, please feel free to send them through to either Brett or myself. And if there is anything else that we can help you with through our business advisory or other services that we've got here at Vincent's, then please feel free to give us a call. If you're not sure who to speak to, then feel free to call Brett or myself, and we can point you in the right direction. So if there's, I don't think there's any questions at the moment, so we might deal with those when we get offline. But for everybody that's attended, thank you very much, and have a good afternoon.
Yeah. Thank you.
Thank you.